Welcome, everyone, to Real Estate 360 Live. I am your host, Ryan Sloper. For those of you not familiar with the show, my guests and I will cover every angle of real estate under the sun, from interest rates to the economy to what's happening in Washington. Anything that affects our local real estate market will be covered here. If you got credit issues, you can call me. If you're looking to buy or sell your home, you can call me. Want to refinance to the lowest rates in U.S. history? And as of last week, that definitely holds true. You can call me. Any questions regarding real estate, reach out to me at the off-air number. It's 877-245-2030. That's 877-245-2030. Make sure you join us every Monday from 2 to 3 p.m. here at WNEW 1580 a.m. from 2 to 3 p.m. in the afternoon. And like I said, if you have any questions at all, please reach out to me at the off-air number. It's 877-245-2030. 877-245-2030. Remember, it's real estate. It's covered here. Got a great show lined up for you guys. Obviously, we had Memorial Day weekend last weekend, so we weren't in here on Monday. So we got a lot of ground to cover from the last week or so. Joining me on our panel is Louis Cammarosano, who is the general manager of HomeGain. Louis is often cited in the media as an industry expert in the Wall Street Journal, Forbes, CNN Money, Fox Business, Smart Money, MSN, and numerous others. We're going to discuss with you about what's been going on in the markets for the last few weeks and how that can affect you and your real estate decisions. Louis, are you there?
I'm here. How are you today, Ryan?
I'm doing well, Louis. How about yourself?
Just grand.
So we got a lot of stuff going on right now. Obviously, it's been a very tumultuous and testy last couple weeks. Obviously, last week, the stock market took an absolute bloodbath. And it looks like this is probably going to continue on. I don't really see anything that's too positive that's going to be able to swing it the other way outside of another quantitative easing, which you and I discussed for some time now, that we feel like that's the only ace in the hole that the United States has, is the Federal Reserve to keep saying, hey, we'll print more money.
That's the trick they have in the book. And, that seems to work because the whole flight to safety seems to be to the US Treasuries, irrespective of the fact that we owe $14 trillion and can never pay it back. But as long as the Fed comes out and shows that they're willing to stand behind the markets and inject liquidity, people will continue to buy that, it seems, and that will keep interest rates low, and that will give a boost to the stock market. You and I have talked about how at some point that's kicking the can down the road. The road eventually is a dead end, but in the short term, the play seems to be interest rates will remain low, and the market will come back when the Fed does its next round of money printing.
Yeah, it was interesting. There was an article on CNN Money this morning, and it was title anyway was Stocks. Investors Pin Hopes on Central Bankers. And it went into detail.
Isn't that crazy?
Yeah.
You're pinning hopes on how much money a central bank may print up to devalue your current dollar holdings?
Because for some strange reason, they feel like by printing more money, it's going to help the economy recover, which is actually completely backwards. It's going to, like you said.
If that were the case, as many would say, then Zimbabwe would be leading the world's economic recovery because they mastered the printing press.
Right. So, that was the title of the article. And then it goes on to say, U.S. stocks got crushed Friday after the government said employers hired only 69,000 workers in May compared with the forecast of 150,000 jobs. The Dow erased all of its gains for 2012, and the S&P 500 and NASDAQ are now down more than 10% from their highs of the year, which means the indexes are officially in what investors call a correction. Well, you and I have been saying for a while that we didn't understand, why the stock market was propped up to 13,000+ anyway.
Right.
Meanwhile, with all this going on now, our 10-year U.S. Treasury note fell to an all-time low.
Ridiculous.
Which, it's actually absolutely insane that the yields are down. I believe this morning was at like 1.51%.
Well, in Germany, they're negative. I think you'll actually pay the German government to hold on to your money now.
Which is, if anybody's investing in that would be absurd. But I'm sure there is somebody. And
supposedly there's safety in the U.S. Treasuries and in German bonds.
Well, yeah, and I guess, there's so much going on right now in Greece. I believe that the elections are, I want to say, it's like June 17th?
17th, yeah.
Okay, so the elections in Greece are in June 17th, and this is kind of a very pivotal moment as to what happens there, because I really feel like our Federal Reserve here and the central bank over there in Europe, they're going to have to kind of come together to bail out the majority of Europe, because I can't see a circumstance where they all agreed to let Greece fall out there because I believe that Germany and a lot of the other countries have too much to lose to do that.
Oh, they're talking now about really strengthening the central planning and bank of Europe to cover everybody.
Yeah.
Do an all-in, and that'll really require additional money printing by the European central bank, and then also, you never know, but the Federal Reserve probably get involved in that, propping up as well.
Yeah, and it's like you said. I mean, we have such a large debt right now. I mean, I guess it doesn't even matter to them. It's just a number. You know what I mean?
Well, it's basically, in a debt-driven economy, that's how they make money. And unfortunately, the debt keeps getting bigger. But as long as they have the potential to keep the game going by printing more, they're going to make even more money. I mean, they encourage debt across the board. They haven't asked, they've done this little phony, let's go on austerity. But once they realize austerity is not palatable to the population, they're going to keep printing money to pay the debt, and it becomes who's willing to buy the debt. And apparently, the fact that the Federal Reserve is willing to buy the debt with money created out of thin air gives investors some level of comfort, which is still, to me, crazy.
So, Louis, then my question to you is there ever a point in time where, the Fed, even though they continue to print money, but is there ever a point in time without, there being some sort of revolution in this country for people to really realize that, that this is just not really sustainable and it's really hurting the middle class and the low class?
Once inflation rears its ugly head in a big way and you have something approaching hyperinflation, then the game is over. Then the printed press has to go in even more overdrive, and then the whole thing comes crashing down.
Yeah.
But so far they've managed to maintain confidence in their ability to sustain the markets, to pay down the debt with more debt, and that seems to be keeping confidence there. But once confidence is lost, it happens quickly.
Yeah, I agree.
And that's really the issue here. Is that if I were in the market for real estate, I'd be wanting to lock down my 30-year loan if someone is foolish enough to lock me in the 3%, 4% range for 30 years. I think that's a good deal.
Absolutely. I mean, it's you and I talk week in and week out that people that have the capacity and the means to be able to buy real estate in today's market, when we're looking at 4%, sub 4% interest rates, depending upon what you're buying, I believe it. And we'll get into this later in the show, that a lot of almost 30% of the applications last month with Freddie Mac were actually people that were doing term reductions from 30 to 15-year, because the 15-year, the average on that Freddie Mac 30-year or 15-year loan was sub 3%.
Wow.
I mean, sub 3%. It's absurd to even say these numbers, but the fact of the matter is that it's a great opportunity for people out there that have that, maybe just sitting on the sidelines. A lot of people don't even pay attention to what's going on in interest rates, other than the fact that you see these the ads that are run on the TV and the radio of, you can get this interest rate, no closing costs. But
actually, if people realize that the rates are not low as a result of normal markets, that they're artificially low,
yep,
and that it should be much higher, would make people realize the bargain that exists in grabbing one of these low interest rate loans.
Absolutely.
Because if you look at Greece, Spain, and Italy, once investors realize that those companies are default risk, the interest rates there have gone sky high. And now in the United States, for whatever reason, people are not factoring in that the U.S. could default on its debt, or may not be able to pay it, or the way they would pay it would be by printing up more money and devaluing what they paid back to you, then you'd realize that interest rates should be higher.
Absolutely.
And therefore, it is a bargain. It's not like a situation where it's normal and you say, okay, well, I'll just wait because these interest rates are going to be around for a long time because this is the normal market. They're not. They should be much higher already. And when this thing happens where people start to lose confidence in the ability of the United States to pay back its debt, other than through, further rounds of quantitative easing and so on, then you'll realize that this is a good deal.
Well, what's interesting, Louis, is, and this is just from, my dealings with people, is that for some reason they just feel like, hey, if interest rates went that low, that they're going to go lower. You know what I mean? That there's potential for them to just keep going lower. And, while we've been wrong.
They have been. they're right in that sense. We've been talking for a year and a half now, Ryan, that interest rates couldn't get that much lower, and they have.
Because we're talking about, if the free market was actually looking at what's actually going on and rational, what's going on with, an artificially manipulated market, which we have right now with all this Fed intervention. And, there's just so much going on over in Europe that the flight to safety is our Treasury bonds, which, I wouldn't put my money in. But
well, fortunately, Ryan, though, all of the world's currencies are tied to the U.S., so in a way, it's like the U.S. is the anchor of stability, even though the U.S. dollar isn't backed by anything like it used to be before we went off the Bretton Woods gold standard in 1971. So people take comfort in that the dollar is stronger than the other currencies because that's it.
Yep, just because. And, I will tell people that, when you see, we're hitting these all-time lows, and we're starting to get to a point, and you can actually see that interest rates are not actually as low as what they actually should be, because what will start to happen is you'll start to get Freddie Mac and Fannie Mae and all the major banks. They'll start to just not pass on these low rates to the consumer. Okay, they'll just start to hedge their bets and make more money. Okay, because it'll get to a point where the banks are like, look, we really can't be lending out at sub 3%. This doesn't make sense for us. So even though the market looks better and the media is saying, you can get a 30-year fixed rate at this, that is not always reflective of the end rate that the consumer sees. You know what I mean? And a lot of people have this common misconception. Well, I heard on the radio that it was this. And I said, yeah, but you have to remember, there's so many different factors that play into you obtaining a loan at that interest rate. Must have over a 740 credit score, must be putting 25% down, must have qualifying debt-to-income ratios of no more than 40%. So, once you add in all those things, now you might add a half to the interest rate. But, I want to really emphasize for those people that are looking to move up to the home that they plan on living in for, the long haul, 20, 30 years down the road, and they want to do that. Consider doing that right now. Because to lock in your long-term cost of shelter and buying a home that you want to live in for an extended period of time and taking out a 30-year fixed rate, depending upon your qualifications at sub 4% interest rates, is just a great deal.
That's different advice than saying, get your loan now because home prices are going up and you're going to be able to sell the house in 8 months or 12 months.
Yep.
You're making a long-term strategic decision to lock in your interest rates, to lock in your cost of shelter, which is going to go up on the nominal basis as inflation continues to push prices higher.
Absolutely. I mean, it's just
prices especially.
Yeah, and I can't emphasize it enough that I just feel that this is one of these opportunities that might be once in a lifetime. To be able to secure your mortgage at these interest rates. Now, granted,
not to secure your profit on a home like people were touting 5, 6, 7 years ago.
And you and I, Louis, we tend to look at things a little bit differently. We're completely not looking at the profit factor. Sure, could you make a little bit money on your property over an extended period of time? Sure, but that's not really the goal with being able to lock yourself into a long-term low fixed interest rate. The amount of interest savings that you could have right now with sub 4% interest rates versus if something catastrophic happened and all of a sudden they shoot up like they have in Europe to 6, 7% is hundreds of thousands of dollars in interest. So, I just feel like, making a decision for you and your family based upon where interest rates are today and being happy with it and knowing that, you can secure your long-term future as far as your shelter cost is concerned is critical. To continue on with that article that I was discussing earlier, one of the guys, Keith Springer, who's the president of Springer Financial Advisors in Sacramento, California, said, if the Fed comes through with a QE program, that could save the market. If not, the market will fall off a cliff. Well, yeah. I mean, I guess basically what all the stockbrokers and everybody else, they basically know that they can't eat unless the Fed continues to print money.
Well, it's true. In a Ponzi scheme, if you don't keep the thing going, it crashes. The question is people are afraid to let it crash and rebuild from the ashes because this is not sustainable for years to keep counting on the Federal Reserve or other central banks to print money to somehow keep the game going.
Absolutely. I 100%.
It's no substitute for productivity and profit.
Yeah, and it's just because you feel like another cash infusion from the Fed, it's not going to improve the overall economy. We're coming up on a break. When we come back, we're going to jump into J.P. Morgan and their $2 billion plus losses, what that means, and is the Fed partially responsible when we come back.